All right, so we had a big labor market print on Friday. It's got many market participants now wondering, what does labor market weakness mean specifically for the world of crypto investors? Well, in today's video, I'm going to break that down for you guys, starting with the basics. You got to have some macro context as to why labor market data is even important when it comes to investing in crypto or investing in risk markets in general. And it all comes down to macro. And of course, the key component underneath this macro view is looking at monetary policy. Now, this is a reminder to anyone who hasn't figured this out from watching my channel yet, but crypto does not pump and dump based off of 4-year cycles, right? It doesn't move off of influencer narratives, mass adoption, whatever anyone's telling you online doesn't matter. It all moves off of macro liquidity. Everything that happens in crypto and in equity markets moves off of the macro liquidity environment that we are in, okay? Rates and money supply are very, very crucial for this. Financial conditions, currency values, all 4 of those things matter dramatically more than anything anyone's talking about based off of halving cycles, or this is the next narrative, or this is the seasonality of the market, or this is the post-halving year. None of that stuff matters nearly as much, or maybe even if at all, compared to understanding the macro moves that the market is making. So first of all, let's break down the labor market's central role in Federal Reserve policy decisions. So the Federal Reserve is the U.S. central bank, and they have a dual mandate. Okay, they operate under this dual mandate framework to achieve both maximum employment and stable prices. Their inflation target is 2%. Okay. That may change over the coming years in this post-2020 environment that we live in after all of this money printing, and we went into that sort of mini hyperinflation period that's made everything around us much more expensive over the past 5 years. But overall, the Fed's goal as of today still is to get inflation to 2% and to contain or to maintain maximum employment in the broader economy. So labor market conditions are a very, very fundamental factor towards this, because obviously the performance of the labor market weighs on how the Fed decides their monetary policy decisions. So the first key significant piece about labor market data is it's a real-time policy signal, right? It provides the Fed with immediate feedback on whether current monetary policy is too restrictive or accommodative, and that directly influences whether to raise, lower, or maintain interest rates. So at Jackson Hole, for example, which was a central bank conference that was back in August. I talked about this one of my last updates. So if you're new to the channel, you've got a little bit of homework to do watching those previous videos. But back in August, what Jerome Powell said at Jackson Hole was, maybe we got to worry about the labor market now, and the weakness is warranting a change in our policy stance. What that means to investors who are understanding what he's saying is, hey, maybe we have to switch up policy to loosen to accommodate this weakening in the labor market. So it's a real-time feedback loop as to how monetary policy is affecting the markets. Now, funny enough, it's not actually real-time. It's much more in a lag, because policy decisions that they make years ago only start to show up, really in any form of dramatic way nowadays, right? There's always this lagging factor when it comes to changing interest rates, when it comes to changing monetary policy. But this is very, very key nonetheless. Now, they have a forward-looking employment focus. They're not monitoring just the current unemployment rates, but they're also looking over the data in JOLTS, for example, job openings, hiring rates, what's going on with wages, how many people are actually participating in the labor force. All of these things matter to gauge the health of the labor market, and that's how the Fed ultimately decides whether the current policy that they have is just right, it needs to loosen, or it needs to tighten, okay? So now, there's always this tension between inflation and employment. There's this trade-off decision that the Fed's got to make, whether they got to focus more on inflation or they have to focus more on maximizing employment. And I'll give you a couple examples here. When the labor market overheats with very low unemployment, the Fed is typically going to look at that and raise rates to prevent wage price spirals, right? We don't want people getting paid too much more money, because what happens there? Well, we're going to overshoot our inflation target of 2%, okay? But on the flip side, when employment is weakening significantly, they're going to prioritize job protection over inflation concerns, kind of like what they might be focused on right now. Of course, we'll have to see what Jerome Powell's speech entails at the next FOMC meeting later on this month, but that's what they're looking at, those 2 key factors. And those are sort of 2 main scenarios that the Fed can find themselves in, both of which we found ourselves in recent history. Now, there's also allowing for, in this case, when we're looking at monetary policy, we're looking at all of these sort of factors that make up monetary policy, every month that we get a jobs report, which is every month, it's not like an FOMC meeting where we miss a month here and there. Every month, they're allowing themselves to look at this data and see, okay, where should we potentially look to recalibrate based off of where we are? So the Fed looks at these data points every month. They look at inflation, they look at employment data, and any sort of surprises in either direction allow them to, okay, well, over time, is this a continuing trend or is this sort of a one-off? And then markets, from that perspective, also look at those things and try to price in whether they're one-offs or long-term trends as well, and try to anticipate what the Fed's going to do with monetary policy, because ultimately that does dictate the directionality of asset prices. Now, another key factor about looking at monetary policy specifically is that it's an early recession indicator. So if you see a rapid deterioration or a rapid, increase in the unemployment rate, then you're likely going to experience a recession at some point relatively soon. So historically, when you see massive unemployment increasing month over month, that is the onset of a recession, and the Fed usually acts preemptively or potentially late, depends on who's in charge of the Fed, right? We've had many instances time over time of them being, somewhat on the ball and somewhat off the ball. But that's when they're going to react with changing up monetary policy. In this scenario, probably easing policy rates. Now, for right now, I don't see us with our current labor market data changing, month over month, that we're going into some massive dramatic recession right now. But if you go back in past history, we have seen periods where the labor market has gotten dramatically worse very quickly, and we've jumped into a recession, and the Fed has had to come in and loosen policy, enact QE, asset markets bottom, and then they really go on a run from that point forward. Overall, if you look at history, during periods of really high unemployment, when you see 1980s, for example, 2008, the Fed was aggressively cutting rates once the data started to get bad to stimulate job creation. So if you're wondering, well, why does this labor market thing that everyone's worried about matter for my crypto portfolio? It's because it has the ability to dictate what the Fed does with monetary policy, which ultimately, like I just said, can contribute to the directionality, or directly contributes to the directionality of asset markets for the most part. Labor market data drives Federal Reserve rate decisions, which ripple out to both stock and crypto markets through shifts in people's risk appetite and shifts in the actual liquidity environment. So what we saw happen on Friday was this particular chart here, and I talked about this in my weekly roundup that I posted yesterday. This chart went from having a slight probability of no rate cut, but the majority, we're pricing in for a rate cut here around, 80 to 90%, let's say. We went from going, no change, potentially 5 to 10%, et cetera, to 100% chance of a rate cut. And then now the question is, are we going to have a 25 basis point rate cut? Or are we going to have a 50 basis point rate cut? Okay, so this is new data. This is what happened, post labor market print on Friday. And what that tells us when we're looking at this as investors, that, investors are getting positioned now and are getting, towards the expectation that the Federal Reserve is going to cut interest rates in response to the weakening in the labor market data. So if you're tracking with me, you can see how changes in the labor market data affect expectations towards rate cuts. Rate cut expectations affect how markets perceive, those rate cuts and where monetary policy is going to go, and ultimately the directionality of the trend. So if the labor market data was really strong, for example, and there was more jobs created than expected, and the unemployment rate stayed the same or even got better, then we'd probably be looking at data right now that would be more tied with, no change to change, more so than 100% we're going to get an ease. Now, are we going to get a small rate cut, or are we going to get a big rate cut? 50 basis point cut, usually referred to as a jumbo rate cut. So how does this really affect crypto markets? Well, if you have weak employment data like we just saw, it does increase the expectations of rate cuts, which we can see above. We just illustrated that. And that makes borrowing cheaper, and oftentimes helps boost liquidity over the medium to long term, and ignites rallies in risk assets like your stocks and crypto, et cetera. So when you have these weak unemployment data prints, it's going to push the Fed over time towards cutting. And if you have softer jobs reports, it can also cause the stock market to drop in the immediate aftermath, right? If investors are worried about a recession. So, for example, like on Friday, we did see the S&P 500 after the open sell off pretty aggressively, and then Bitcoin sell off pretty aggressively because investors started to price in the potential for a recession. Now, will this materialize? Only time will be able to tell us. And will that trend, continue throughout the week where the market continues to sell off? We'll also have to see. But this is sort of the immediate aftermath effects of what happens when we see softer labor market prints than the market expects. Right? Crypto markets are always going to mirror reactions in riskier equities, vice versa. Right? They're sort of a proxy for each other, and they're in the similar spot on the risk curve. So when you have rate cuts driving bullish sentiment, that's a good thing for crypto. You have US dollar weakening, also a good thing for crypto, and that increases the demand for assets like Bitcoin and like Ethereum. But mainly Bitcoin is the most important one to focus on, and then whether altcoins are outperforming or underperforming is something to worry about within crypto specifically. But volatility in both of these markets are going to spike around these labor market releases. So always know that, month to month, the beginning of the month, first Friday of the month, we're always going to get a labor market print that's going to tell us what the overall directional trend of labor market is, and potentially give you some clues as to how the Fed might handle that based off of their policy. Now, if we saw a really strong jobs print, right, this could delay rate cuts, right? It tempers the expectation for a rate cut, and sometimes that prompts a short-term sell-off. So I'm sure if we saw a very strong labor market print, just last week, we probably would have had a sell-off as well. So you can't win immediately right after one of these sort of, above average or below average prints, or above expectation or below expectation prints, I should say, as markets, don't really like uncertainty, right? They kind of want to understand, okay, what's going on, and they'll reprice immediately. Not that has to mean that any sort of, medium to long-term trend gets immediately broken. It's only over time, right? So there's some context for you guys when it comes to labor market weakness and what that means for asset markets, what that ultimately means for crypto, right? Macro is everything to drive, crypto prices up or down, mainly Bitcoin, and then altcoins follow based off of dominance and, based off of liquidity within and outside of crypto. But I want to talk about where we stand in September of 2025, because market volatility has heated up quite a bit since Jackson Hole, where markets got their first credible hint, like I said at the beginning, towards chance of seeing imminent rate cuts, right? The September 5th labor market data that we just saw last Friday was arguably the biggest piece of data that we had to work with as investors, and the Fed, of course, to look at before we have that next FOMC meeting, which is going to happen next week. So now that we've seen the weak print, markets are now pricing in this 100% chance of a rate cut, which is an easing of monetary policy. It's not a tightening. Remember, we began to ease last year in September. We went from very, very high terminal rate, and we started to have some cuts. We had 3 cuts, and then we started to pause from December forward until now. So the real question is, well, okay, where do we stand? But second to that, investors are divided on, well, what does this mean for the market? Is this going to be a good thing? Is this going to be a bad thing? And I've got a couple of pieces of data that are helping me understand where I stand in terms of my thoughts on where the market's going to go. And first of all, I want to share the actual data itself. So the expectations were that we were going to see a 75,000 job add. We only saw 22,000. And then we also saw some revisions where we resulted in net losses back in June. So the labor market health has, deteriorated very quickly, as you can see by this chart. This is a slide from last week's BNB presentation for members, showing it to you guys to illustrate what we talk about, and also, how I teach members why studying this data really matters when it comes to developing your investing strategy, because this shapes monetary policy. So what we can see here is the fact that labor market has been getting weaker, less jobs added, unemployment rate has been going up. So the signs are there for the Fed to start cutting and changing policy. Now, another thing we talked about was the fact that PMIs were getting better. They both improved compared to July. So it shows that, and this is for anyone who doesn't understand, the Purchasing Managers Index. This is a monthly survey of business managers that signal whether manufacturing or services sectors are expanding or declining. So if you're above 50, you're expanding. If you're below 50, you're contracting. If you're at 50, you're unchanged. But all of these metrics improved over the prior months in the summer. And then we also saw, along with this data, the job openings, which is the JOLTS, were not very good. The weekly initial jobless claims were also not very good. So the bottom line here is that a lot of the economic data is actually improving. Another point to add to this is the fact that GDP was revised to 3.3% from the initial 3% estimate, right? So that was a bump up. And then we saw final sales to private and domestic purchasers was revised from 1.9 to 1.9% from 1.2%, almost double, right? That was really big. But the labor market data is weak. So everything else is getting better. Everything else is strengthening. Inflation, it's been sort of rebounding a little bit, but overall the trend is that it's been cooling off over the past couple of years. And the economy looks strong. Underlying, the labor market looks weak. So it's telling the Fed we probably need to cut, right? What we saw on Friday was stocks and crypto rallying initially right after the news came out, but then they reversed upon market open on recession fears. Now, is this justified? Well, I think if all of these metrics were getting worse at the same time, recession fears would be much more justified. As of right now, I am not seeing it in the data. I'm only seeing it from a labor market perspective, which is not everything, right? It doesn't account for people who work online, people who start their own businesses, people who quit and start to do their own thing or work for other people as, subcontractors, for example. It doesn't include all of these things in the labor market data. And also, the government has been closing off the borders. They've been deporting lots of illegal immigrants that have been working in the economy. That's another contributing factor to an increase in the unemployment rate. And also the factor that AI has been making it more efficient for businesses to hire less people and to continue to grow more and put out more productivity. Therefore, you need less people, less jobs created, less jobs opening. Policy is very high. It's expensive to borrow money. All of these factors, right? You can see how all of this matters so much. Now, a couple of analysts described the report as confirming a stalling labor market with job creation at stall speed. This is concerning because this is the first monthly job loss revision that we've seen since 2020. And many economists also believe that the labor market is bouncing on a knife's edge, with unemployment rate being the highest since we saw in 2021. So people are worried about this. People are worried about, is the labor data even real? Is it authentic? I know Trump did fire the BLS commissioner in August after the data. So people are not quite certain about what's going on in the markets right now. There is stress in the labor market, undoubtedly. It is unclear to see how much stress there is until the data is revised in the future or in the near future, or potentially not even in the near future. We'll have to see. And that's where we'll understand the real truth of the scenario here and the situation that we're dealing with. But for right now, markets seem to be a little bit worried about this, but not overly worried. Again, we've only had one trading day. Today is Monday, so we'll see when the market opens soon what the reaction is. Now, a couple of expectations changed. Bank of America made the most dramatic pivot out of all of the sort of mainstream firms, completely reversing their we're not going to see any cuts in 2025 stance to now forecasting 25 basis point cuts in December and also this month in September. And then if you look at Tom Lee, for example, mentioned him a couple of times on the channel, and he put together BitMine, which was a very clear signal that institutions are here to buy ETH, and it's time to go long on ETH. But he doubled down on his September optimism, saying that Fed rate cuts starting in September will drive markets higher, citing this as only the third time in 50 years the Fed cuts for the first time in September after not cutting all year, right? So the last two examples we can see of this is 1998 and just last year in 2024. And you can see what happened is in 1998, we had that typical summer sell-off. We had a rate cut, right? And then the market continued higher at this point. Economy was strong, right? People were still steadily taking on more risk here. Financial conditions were loose, and in the process of loosening, dollar was weak, right? And actually weakened a bit on this rate cut. And then last year in 2024, same thing, right? Everything sort of in an uptrend, running strong. Again, this was in an uptrend before it pulled back over the summer. We had a pullback over the summer last year too. Rate cut, market was freaked out. Is the rate cut going to mark the top of the cycle like it did in 2000 and in 2008, for example? It didn't. market continued to rally higher. So he's saying in both of these scenarios, this was the first time in the year that the Fed cut rates. They did it in September. Markets continued to rally to new highs, right? 1998 and right now are being drawn as parallels in overall sentiment amongst investors, and also sort of like these bigger level bubbles that we're in with AI and technology and software and everything that's going on right now. People compare the environment in 2025 as being similar to the environment in 1998 before we eventually got to the dot-com bubble in 2000, right? So a lot of investors don't anticipate that we're actually even close to reaching that bubble level yet. For at least another 1 to 2, and some investors even think five plus years before we reach a massive level where we have a significant crash like we saw in 2000 or 2008. So just to remind you that the chances are of this rate cut, as of right now, are 100%. We're just deciding, the market's deciding whether we're going to see a 25 basis point or a 50 basis point cut going into the meeting. And last year we did have a 50 basis point cut right off the rip in September based off of weak data from the summer, employment data from the summer. And so it might be a repeat of that as well. We'll have to really see. But the interesting thing is, here's 2025. Here's where we are right now. We've had a pretty significant dip already this year. We haven't had any changes to policy yet. People are starting to freak out and wondering, is this a bubble that we're in because the market has rebounded so fast on what a lot of people think is bad news, tariffs, Trump being kind of crazy in office in the views of many people, or more mainstreamers, let's say. But if you look at the net leverage, right, it's not at all-time highs like it was back in 2021, for example. If you look at the long-short ratio, it's not even as high as it was earlier this year before markets fell off face of a cliff. So most people are actually bearish on the market, right? People are calling for a top right now and they're bearish. And the consensus is usually never right in markets, right? You can see the bull-bear spread, for example, negative 10%, right? We're down at levels that we saw only previously this year when we were actually in a massive downtrend and people were very uncertain and we didn't know what the impact of tariffs were going to be and we didn't know what the impact of everything was going to be back then. Now we know that Trump conceded, right? The bond market broke and markets have been doing well. But if you look here, the latest AAII bull-bear spread, right? But if you look here, the latest bull-bear spread is at negative 10.6% for the week ending in September 4th, meaning that 43% of investors are bearish, according to this survey. Only 32% are bullish and most are neutral, right? And when you're neutral, you might as well be bearish if you're neutral because you're not long, is my argument for that. So you have the majority of the market bearish right here, and this is a negative spread that is well below the long-term average of 6.4%. Okay, so people could be calling for the top of the market based off of the fact that we're going into 100% chance of rate cuts on weak labor market data, but a lot of the fundamentals are strong when it comes to looking at global liquidity, looking at the US dollar not regaining any sort of degree of strength yet. You have investors offside. This is one of the most hated rallies in recent histories because people got so scared back in the spring, they didn't want to allocate. They didn't want to beef up their positioning at all. They wanted to sell. And a lot of people actually sold the rally thinking that this was going to be just a dead cat bounce before a bigger move lower. They didn't understand what Trump had come out and said in the spring, and they didn't understand the ramifications of the big, beautiful bill, the Genius Act, all these things, fiscal dominance, massive fiscal stimulus, the fact that the government is just spending more money than ever before, and they're trying to force the Fed's hand. They're trying to lower rates. They're trying to create and engineer an economic boom. And a lot of people just don't understand or even think that's possible when asset markets are already at all-time highs. So my conclusion is that these rate cuts over the near term are going to contribute to a further rally in risk markets until we get a meaningful, durable reversal in the US dollar that starts to kill investor risk appetite because the dollar is strengthening, et cetera. But until that happens, I would say until we see a rollover in global liquidity, which will coincide with the dollar getting stronger, I'm going to have to say that these rate cuts will contribute to further upside in markets over the next couple of months. And we'll really just have to see, the speed, the size of the cuts, the pace of the cuts. How many cuts do we see over the next couple of months? How many cuts do we see over the next year, for example? How do markets respond? Most importantly, when it comes to financial conditions easing, many times we've seen that coincide if there's, dramatic weakening in labor market data. It also paints the path for a potential QE cycle as well, where we see the Fed, actually buying assets and putting it on their balance sheet instead of selling them off into the market, which is quantitative tightening. So my conclusion on the matter is that rate cuts will be bullish for the market, and that is not a consensus take right now at the moment. That is very, I don't want to say very contrarian, but a lot of people are worried that this might mark the top of the market now that the Fed is cutting rates. Why are they cutting rates? Because labor market is getting weaker. But is it weak enough, and is it weakening fast enough to outpace the improvements we're seeing in ISM, GDP, wage growth, consumer spending, all those sorts of factors that also are very important when it comes to looking at the entire sort of situation that we're in the labor market, or the entire situation that we're in the macro overall picture, I should say. If a lot of this stuff sounds confusing to you guys, that's okay, because it is, right? Imagine it like a Rubik's Cube, right? If you don't know how to solve a Rubik's Cube and it's all mangled and you're looking at it, you don't even know where to start, because every move you make seems to move you backwards the other way. It doesn't really make sense. But learning macro and really understanding the relationships and the correlations between all these factors, labor market, inflation, monetary policy, government spending, treasury issuance, all these sorts of things, financial conditions, bond market health, bond market stress, yields versus bond prices, all of these things, the price of gold, the directionality of the US dollar and other currencies, all of these things, once you understand them, and once somebody teaches you how to put the Rubik's Cube together for the first time, you never forget it, right? So that's why this stuff is so important. And many people on YouTube will try and preach this pattern or this technical thing, or this seasonality or this altcoin or that whatever. That's the ticket to understanding crypto, and it really isn't. The ticket to understanding crypto is the ticket that helps you understand all their markets and how they trade in the world, which is macroeconomics. And your ability to break that down and decipher the data in real time is really what separates you from the rest of the pack as investors. So if you want to learn more about this, please do subscribe to the Bull Market Blueprint YouTube channel. You can follow me on Instagram as well. I post little snippet videos nearly every day educating on the markets. I have an announcements channel called Luke's Brain. So if you click on my profile on your phone, you'll be able to join that, and you can sort of hear daily rants about the market here and there, sort of get an insight on my life as I monitor and stay up to date with these markets in real time every single day. And if you actually want to work with me and you want to have access to my own personal portfolio, crypto and equity portfolios, and access to almost 300 global investors who are doing this with me every single day and following my moves, sharing their own moves, I encourage you to sign up for Bull Market Blueprint. Submit an application to us. I'll take a look at it. I'll see if I think we can actually help you and you'd actually be a good investor for the strategy that I follow and that I show members how to develop on their own and ultimately follow themselves as well. We are massively 5-star rated on Trustpilot. We do not have a single review that is not 5 stars. We do not cherry pick our reviews. We have the review link posted publicly in the community for people to write their reviews. These are not, prompted, biased reviews. These are real people in the group that have written all of these messages towards us, thanking for the guidance that we provide in BMB and also encouraging other people to take the plunge as well. I know it can be sort of scary to consume materials and buy things from people over the internet, but welcome to the new world. That's how people develop. That's how they level up, and that's how they grow. So my intention with this is to show you as much social proof as possible that what we do works, that we've been very successful. I mean, we took a pretty big position. We took a really big position into ETH over the summer when almost nobody else did. Collapsed all altcoin positions into ETH. Didn't decide to allocate into any other altcoins except for one. That was the solo outperformer of ETH this summer, because ETH was the dominant one, right? ETH season was what we saw, and now potentially we might be rotating into a different phase of the market, which I've covered in the group. But we crushed it. I've heard of many other crypto groups. Nobody else was stacking ETH this summer or got as bullish as we did on Ethereum. We have a lot of happy members. We bought Coinbase before it got added to the S&P 500. We were buying Bitcoin while everyone was panicking back in the spring. We were buying Hype, for example, back in the spring as well. We sold that for plus 63% in less than a month. We've made lots of money off of MicroStrategy. We've sold before things got ugly earlier this year. We've made tons of money off Solana. We're rebalancing our portfolio. Actually, this week I've just done a rebalance to mine and posted it in the group. So we're making a lot of moves ahead of Q4 here, and we're not bearish on the market. So if you want to join us and you want to get with the macro that actually matters in the markets right now, and what people are actually looking at towards making the proper decisions, this is the time to join us in Bull Market Blueprint and level up your strategy. And we'll actually do an onboarding call with you myself, where we have a look at where you're at and how the program can best help you with the resources that we have achieve your goals when it comes to investing in these markets, and ultimately help you become a better investor by giving you as much of my 6 years of knowledge as we possibly can in just a couple hours a week. So if you're time strapped, this will work for you. The only thing where it won't work for you is if you don't have the capital to meet our minimum requirements, which is 50K. So if you have 50K or more, we do highly recommend you submit an application. And if we think we can help you, we'll reach out. And if we don't think we'll help you, we'll also reach out and let you know that, and sort of try and point you in a good direction to go from here. But ultimately, if you have a willingness to learn, you have a couple hours per week, and you have 50K per more, what I do every single day should work for you. It's worked for hundreds of other investors that are in the group with us. And we have a 90% renewal rate year over year of people staying with us in the group, which is unheard of in this space. So highly encourage you to join Bull Market Blueprint. Submit an application here with this QR code. You can just scan your phone if you want to join us, and I'll review these as I do at the end of my day every day. Cheers, guys. I'll catch you in the next video. Bye.